I'm not surprised if none of you have heard of me. I'm not surprised if none of you have heard of Clearlink. So just by way of introduction, let me just give you a sense of this little startup that I started in my fiance's basement. All right, how are you? Clearlink is an anagram for my wife's maiden name, Earl, my last name, Clarke. You do certain things out of love, right? You do certain things, especially when your wife is financing the entire operation. She was the #1 seller of OxyContin, legally, in the country. She had this great sort of what we called mattress money that she had sort of socked away selling legal drugs and was able to finance this business. I had another business prior to that. I had to buy my way out of that business in 2001. Does anybody remember what the business climate looked like in 2001? Remember the dot-bomb bubble bursting? Nobody believed in the internet any longer. Capital markets were completely dry, yet I, in my hubris, was starting a business in the dot-com space. So there was no money to be raised, even if I had the ability to do that, even if I knew how to raise that. So it was with her help that we were able to start this business. Starts out in a basement, but what we did, and one thing that we do well within our business, and did well, the one thing that we did well early on was align ourselves. We found alignment, and that was out of necessity more than anything. That we aligned ourselves. The climate was such that the first web development company that we went to, certainly we didn't have that expertise. I had never programmed a line of code myself. I didn't know, what I would do, so I went out to this web development company, and they were everywhere. But they were charging, if you can imagine, for a 6-page brochure-style website, $100,000 at the time. Sounds expensive, right? Well, we put down our deposit. The first deposit that we had made was about a $15,000 to $20,000 deposit. That was a lot for a guy like me who had just bought his way with his fiance's money out of his first startup. By the way, that startup was a door-knocking business that I started in the walls of a company then called Apex that's now called Vivint. So I had some good partners that had walked me through this. We found some alignment. But this business that we had partnered with, that we had given the deposit to, poof, gone. They were out of business just weeks later. Put together another deposit. We're a little bit more conservative this time. It was maybe a $10,000 deposit. Just a few weeks later, poof, they were out of business also. What do you do? What do you do? You've just failed really quickly twice. It's not your money. You're borrowing it from somebody who has no legal obligation to you at this point, right? So we retreated, regrouped, decided that we would look for alignment. This time, we said, we're not going to give $1. We weren't going to spend $1 in bringing a group in to partner with us in the traditional sense. We said, okay, listen, your success is our success and vice versa. If you can generate sales a la what we now know as a cost per acquisition or affiliate model, you guys take a certain percentage of each one of those sales. That makes a lot of sense today. That was a new concept then. This is 2001, again, remember. So to their credit, they did. And this was a company called Odyssey Web, headed by 2 partners, Phil Hansen, Bruce Westonsko, Bruce being the tech expert, the background in accounting, and his partner Phil Hansen, who was their CEO. They were the key to our success in Clearlink from the early days. From the day that we turned on that relationship, we were profitable. We ran a lean organization. We knew exactly how many sales that we needed to do on a daily basis to be profitable, and we were able to scale from there. Fast forward now to 2014. Of course, we sold the business almost 4 years ago now. Hard to believe that that time has kind of flown by for us, but that is this business today, the business that started in my then fiance's basement. 7th consecutive year on the Inc. 500, 5,000 list. Top of the list several times within the Mountain West Capital Network, about 1,500 full-time employees today. But again, you're probably asking yourselves, why don't I know this business? By raise of hand, anybody know this business by chance? Okay, a few more maybe now. But not everybody in here, because this business was built on the backs of other brands. Now, that was a benefit to us. It was a really nice thing to be able to build our business leveraging the brand of Dish Network or DirecTV or ADT or CenturyLink or the like, Verizon, AT&T, and so forth, and ultimately into dozens of brands that we were representing. But we would answer the phone as if we were these brands. So no real brand equity in a Clearlink versus a business that's growing because they have a name that you would recognize. They come onto campus and you say immediately, I want to work for this company. Well, we did a poor job at that early on. I think Clearlink is doing a better job. Certainly by raise of hands, they've done a better job so that you know. And also there are about 500 of those 1,500 employees are based here now in Provo. We're really proud of this organization and what they've done. They're today generating billions of dollars in revenue for those brands. Does that translate into billions of dollars for them? No. So again, I'm going to talk to you a little bit about the value chain and the value proposition in every business. The downside of that partnership, I'll tell you right now, is that when I started the business, I knew that I wanted to do something else. My sweet spot in any business is sort of from inception, getting things to a place where you're doing at least $1 million of earnings. Not revenue, you're actually profitable. I believe as an entrepreneur that it's after that it's really sort of just keeping it between the rails. You're scaling up a business. That's not terribly exciting for me. So once we had achieved that early on, I was looking for sort of that successor plan. And we thought in 2008, even later than I had hoped, that we'd bring in a buyer. And I had brought in a CEO to run this full time. He was the partner that I brought in from Odyssey Web as we acquired that business ultimately. And as we brought him through, of course, we didn't know what was going to take place in the fall of 2008. What happened in the fall of 2008? The world fell apart. Real estate market, investment banking, Wall Street, we're all reeling still, maybe a little bit from the Great Recession that took place. So 2008, I find myself without a job, without a company that hadn't sold. Of course, they still have my ownership in the business, but listen, I've got this free time that I hadn't planned on having. So what do you do in a situation like that? Well, I'll tell you what I did. Is that I set up an office in New York where I was every other week on 56th and 6th, learning about what I would do with this next step in my life. And that was really where we sort of honed and crafted what we now do within Clarke Capital. We looked at a lot of different businesses. We kissed a lot of frogs before we found businesses that we were excited about. We do that still today a bit, but that's where we really developed and honed the strategy. Bringing it back to Utah, as we did, and I'll talk to you a little bit more about what that strategy is. We looked at sort of what the landscape is. What's the competitive landscape in investing in Utah? Well, this right here was kind of our competitive landscape, right? We certainly weren't involved, but you probably already know this, being students of this great university, but listen, you know there's angel investing, right? This is you passing the hat, mom and dad, rich aunt and uncle, friends and family. That's your angel group, right? Your next group, venture capital. Not all investors are venture capitalists. Not all are vulture capitalists. Not all are in that bucket, right? That is very early stage, sometimes pre-revenue, right? These are writing checks in the size of $1 million to sometimes, $10,000,000 checks, okay? Next stage. Right here, growth equity, okay? That is to take out a bad business partner. That is to scale up a business. That is intended to stay on the balance sheet and grow that business to the next step, which is, of course, private equity. Again, a lot of you probably know this. If you don't, you should. That private equity checks generally 25 to billions of dollars, 25 million to billions of dollars, where they're buying out people that had built these businesses. And creating a liquidity event for them. So generally, growth equity is not a liquidity event unless you're buying out deadweight partner that's not helping the business or trying to scale up the business in some form or fashion. But that's the landscape. In Utah, of course, you probably know these folks that have been here to the business school. You've got Signal Peak, used to be vSpring, Pelion, Mercado. You know a lot of these principals in the venture space. You know a lot of these players: Ares Capital, Solamare, based out of Boston, that's Mitt Romney's multifamily office. Sorensen Capital, great presence, does a lot of deals here. Huntsman Gay is not as active in Utah now that they don't have an office here. They were East Coast, West Coast, primarily now Palo Alto-based firm. Peterson Partners dips into both sides. In their Peterson Ventures, Clint Peterson's successor to his father, Joel, is doing a great job right now in managing that. I have a healthy respect for them and all of these groups right here. But again, gaping hole in growth equity, gaping hole. So what is growth equity and how did we hone our thesis? Let's see if this is gonna go to the next slide. Maybe not. There we go. No? There we go. This is the thesis we developed in that 2-year period of time that I spent out on Wall Street looking at different investment vehicles, different opportunities. What is a guy like me gonna do? A lot of my friends, a lot of those entrepreneurs that you've had in here that have sold successful and multi-billion-dollar businesses say, hey, James, why don't you go sit on some beach and drink an alcohol-free margarita and enjoy the rest of your life? And that just wasn't for me. And for me, it's about probably what it is for you folks as you'll look at your lives and analyze sort of the cliff that we sat on selling our business. It's about stewardship. You know, you talk about here at this university, learn, earn, return. That's the stewardship that we employ within our family, in our family office. And this is the exciting part about what we do. Yet, we still didn't have a thesis. So we put together this 5-point, really simple, you know, sort of battle cry, if you will, as we put together our business, looking at businesses in that $1 to $5 million of earnings. So you've got earnings, you're profitable, you've got EBITDA. How do we help you scale? Second is solid management. That's highlighted because it's the single most important thing to us. When you can choose those with whom you're working, it's the most important thing. A lot of people say life is short. Try having a bad business partner. Life can be long, and it is when you're with the wrong people. So choose those partners wisely, and we take that the most serious of all that we do. We can correct behavior, we can correct finances, we can help correct your legal strategy and IP and all of those other things, but generally we just can't change someone's personality. We generally can't change someone's work ethic. So that's what we take the most seriously, and that's why solid management, these people that we want to wake up in the morning and go to work with, is highlighted here. The third, Mountain West region. That's important to me out of simple fact that I want to be in and out of a certain geography in a day. I want to be have our meetings, come back home, and I don't want to be on the road a lot. And I also believe, and probably more importantly than even my selfish travel schedule where I'm a little bit more protective, I want to reward businesses here in Provo. I want to reward businesses here in our state of Utah. I want to reward businesses and build businesses in this Mountain West region where I'm from and where I grew up. Fourth, a defensible IP strategy, extremely important. Some of the businesses that we haven't invested in, or that we have invested in, have not necessarily had this IP strategy, but we could see it. We could see an opportunity to build an IP strategy. And we talk about building this moat, building this wall around your business so it's defensible. We have a portfolio company right now that probably the largest part of its enterprise value, apart from even its sales, its operations, and what it is, its brand equity, is in IP. And there's no question that we are able to help and develop the IP within a business. So we're a very small family office, 14 full-timers in my office. Of that, 4 are in our legal department. It's our most expensive line item in G&A. It's our most expensive outside reoccurring expense. We spend more on legal than we do on anything because that's how we build our asymmetry and our differentiation. And I'll talk to you a little bit more about asymmetry in a moment. And then the thought is, of course, that there are, as you see, infinite opportunities and finite capital. So if you've got only so much capital to work with, why not swing for the fences? We talk about downside protection a lot, and we don't like to lose money. It's a pretty basic tenet, right, to investing, that you don't like to lose your money. but we like to swing for the fences. And so, as we say that's part of our strategy and part of our thesis, it actually is. And I'll tell you about a couple of businesses that fall within that category in just a moment. Let me see if this works this time. I don't know where I should be printing. So this is one. So this, let me just tell you, let me start it off by saying if I had to do this deal again, I wouldn't do it. January of 2011, a small group based in Salt Lake City came to me and said, hey, listen, we're investing in this company, Contour. Anybody ever heard of a Contour camera? Well, listen, I hadn't. Nobody knew about action sports cameras. Nobody knew GoPro, but what I was told was that there are these two action camera companies. One is called Contour that we're discussing here, and the other one is called GoPro. You guys all know GoPro. Of course you do. Because this company got out-marketed in every way. But let me just tell you the sadness of this story to me is that it's a better camera. It was a better camera then. It's probably not a better camera today. It can be a better camera, better technology, but what did GoPro do? They marketed the tar out of this. It was fantastic. So they, within $10 million or so, were about the same size. They hadn't grown as fast as we had. Contour was the first 1080p camera in HD, right? So they were the first one that was wireless connectivity, the first instant on, the first camera that was waterproof without a case. A lot of firsts, a lot of innovations. But what happens when you've got a CEO that says, I want to stay small? You come to that CEO and you say, hey, guess what? I work with this little company called Walmart. And we could probably do some more business with them because they like us. And he says, again, I want to stay small. How are they going to perform in the market? They're not. So it was a great lesson for us to watch these guys go from 2011 when we first invested, had a great relationship with Best Buy, we're in all of the Best Buy stores, went into the Apple store. Can you imagine a higher compliment in consumer electronics than Apple choosing you? That's a great compliment. And I've always thought that, Contour versus GoPro, a box versus something cylindrical and maybe a little sexy, seems a little Apple 1989, if you will, right? So there's a great comparison there, but again, we didn't grow the business. So it was our only indirect investment. And if you understand indirect investing, that was me going through another group. That wasn't me writing a check, handing it to Contour, saying thank you very much in exchange for X equity. Indirect investing. Great early lesson for us in our first year, to not indirect invest. We only now direct invest. Well, you can see what happened. Here's the punchline. 2013, I'm at my closest friend's wedding out in Miami Beach. Get a call. James, that $1.5 million check that you wrote 6 weeks ago, if you don't write another one of those checks, they're going out of business. What would you guys do? I see some shaking heads, maybe even some scratching foreheads. What would you do? Okay, so by the way, raise your hand if you've had, well, don't raise your hand, sorry, that's a terrible idea. If you've had $1 million in the bank lately, don't raise your hand. Nobody wants to know, right? It's real money, and I don't care if it's $1, $1 million, $1 billion. It's always real money. It's always real to you. So you could say, it's Bill Gates or it's some wealthy individual. It just doesn't matter. It always matters. It's always real. And when you're in that position, you'll know that. That's exactly how it is. So as you're looking at this, what do? They're going to go out of business. Or do you write the additional check? That would put you $5 million into this deal. You're the single largest stakeholder in the business. What do? Here's my case study for a moment. Right? Any thoughts? Well, I'll tell you what. Oh, yes, please. I actually have a daring participant. Of course. It's the right answer, but it hurts. It's painful. It's real money, right? Again, don't care how much money you have. It is, in fact, the right answer. It is a sunk cost. And you'll find that a lot of investors become very emotional, fall a lot in love. Gosh, guys, we've run a lot of companies, but my kids talk about this company. They don't talk about pet food. They don't talk about online retail. They talk about this one. There was a little bit of a love affair there. It would have been really easy to write a check and say, okay, live to fight another day. But their strategy was off. And while, they're underfunded or whatever took place. It was either, one of a couple of different things that caused the demise, and we won't go through that today. But we decided to let it run itself off of a cliff. Sunk cost. Painful. Very, very painful. Try answering to a spouse why you just wrote another $1.5 million check to this. If it's your last $1.5 million, even that much more painful. But we wrote that check. We let them go off of a cliff. We were fortunate enough to the next year come back within the next 60 days, buy the business out of receivership. So that's the good news, but it's also the bad news. Now you've got this business, has no more employees, all of the relationships, Apple Store's gone, Best Buy gone. They know it's out of business. They kick you out of their store, right? So now what do? You bought it back. It was a sunk cost. You bought it back.
Give all your extra products to your kids.
Oh, okay. Man, that's a very nice parent. We brought in a CEO and hit the reset button. And I'll tell you what, we've really looked at an IP strategy in this one. I think it's probably a war that can be won. I don't think it's a war that we fight relative to the GoPro, who was the 800-pound gorilla, probably the 8,000-pound gorilla now, at a $10 billion market cap. I think they've been as high as a $12 billion market cap. So we focused on something, creating value within an IP strategy. This company had dozens and dozens and dozens of patents in various forms, and that's what you can do when you're the first to market. And so they were able to do that. And that's a story that I want to tell you when I come back in the next several months. Seth, let me do that. That we're working on right now. So really exciting stuff. But we had to pivot, and we had to retreat and regroup and decide exactly how we were going to run that business. Is it the traditional, hey, go out to consumer electronics run? Or is it X or Y or Z? So it was a pivot again strategy. Incredibly difficult, but I want to return and report on this one. This company, VetIQ, or parent company, True Science. So in 2010, the two principals there had come to my office, my home office, of course, by then, as I'm getting ready to sell Clearlink. They knew that I was going to have an exit, looking for investors. These two individuals, CEO, COO, CEO, former CEO of Polaroid, pretty bright guy, had grown a business to about $1 billion of sales in 3 years. Is this a guy you'd believe in? I think so. I like the story. COO, he'd been the business partner of a guy right here. You might not recognize the top of his head, but this is Jack Nicklaus. As a favor to this COO, Jack made him his only business partner he'd ever had because he had taken the struggling, publicly traded Nicklaus companies private. And they were then business partners. He's done great things with this company now as a pet lover and all kinds of things. But what does a guy like me have business starting or helping start or run a pet food company? I came from tech. What makes me think that I can be successful in this business? I didn't. And we said no 3 different times. It wasn't until the 4th time that this group came back to us and through our due diligence learned that these two partners had taken their collective fortune of about $100 million and they put it into what they thought was very safe. And that was Boise real estate in about 2004, 2005. How do you think that ended up for these guys? Not so well, just like everybody else during the Great Recession, right? So getting clobbered in 2008, 2009, 2010, they start this business. About $1 million of sales, they come to me and they say, hey, we'd like you to invest, but we've got this strategy. We went back to our partners at Walmart and Sam's and Kroger and Costco and said, what 2 categories grew during the Great Recession? You know what the answer was? Babies and pets. So they came out with this dual strategy, and I really believed in the baby strategy. I'll tell you, this baby strategy was really compelling. It had a great brand behind it. The most notable pediatrician in the country, a Dr. Sears, was really interesting. But guess what took off? Pets. This is a pet company today. They ultimately jettisoned the baby side of that business, and you can see their trajectory going from $1 million-ish that first year before we got involved. We placed our first $2 million 2 months later, they came back to us and said, hey, we need some more money. Our sales have taken off. That's a good problem to have, right? But it's a problem nonetheless. We need $4 million because we got this great big order from Walmart. Well, as you can guess, most companies start, local shop, local retailers. They move out to sort of regional, and then you go to specialty. And in pet, it's specialty example would be like Petco, PetSmart, right? And then you go out to national retailers. You go out to a Kroger or somebody else, or you do a road show at Sam's or Costco. Well, these guys broke all of the rules, and they went straight to the biggest retailer in the world. Went to Walmart. Walmart fell in love with this business, and every time Walmart then in the pet aisle had a problem that they needed to solve, guess who they go to? Guess who they went to then? This company, based out of Boise, Idaho, of two great operators that always execute. These guys never miss. If they say they're going to be in your facility filling this much product by this day, it is always there. So if you're Walmart, that's a big problem being solved. In fact, by the way, if I'm Procter & Gamble, or if I'm Del Monte Pet, or if I'm the former, if I'm another Mars or somebody like that, I'm worried about this group because they're taking shelf space from me during, as they grow. It's not just, hey, there's an abundance mentality. There's a finite shelf space within Walmart. And Walmart has looked to this group because we don't walk into Walmart and say, hey, we need to charge this, and you need to make this amount of money, and if you don't take it, then sorry, we walk and we'll put our product someplace else where Walmart would actually need that product. We come in and we say, what do your margins need to be, Walmart? What problems can we help solve for you? So it ends up being a great relationship. Whatever stories you hear about a Walmart that might not be positive, don't believe them. It's candidly the best company that I've ever been able to work with. They pay on time. They do exactly what they say they'll do. They're conscious of the environment. They're conscious of their retailers, and you are partners with them. In fact, this company, as you can see through their growth, going from 38 the first year in business after we put our first $2 million in, which turned into $6 million halfway through. By the end of the year, we had $12 million in. Pretty deep for a group like us that likes to write $1 to $5 million checks. Well, we had ultimately put in about a $25 million placement into this business, went out to find more money, more capital, as you can imagine, in manufacturing, and now with 250,000 square feet here in Springville, Utah, this is a very expensive business to run. We've raised about $100 million of equity and about $100 million of debt. Now, this is ABL, so this isn't traditional debt that sits on your balance sheet, right? You look at this business, and this is how a company gets to Supplier of the Year status with a Walmart. And that's what this company was awarded just this last year, just earlier on in 2014. That is a love affair with a retailer, and that is a great symbiotic relationship that we have with a wonderful partner like Walmart. That said, what's the future of this business? Let me ask you this question. So we look at the bottom. There's a big question mark there. So we're projecting, close to $250 million in sales next year. It's profitable, probably does somewhere in the order of $30 million of EBITDA. So anybody know a comp for a business like this? Anybody follow a company called Freshpet that just went public? So let me give you an example. Freshpet, great company, great product. You might have seen it in your Kroger store or in a Costco or in a Walmart. Refrigerated dog food. They're about 12 years old, by most accounts, 10 to 12 years old. Former executive team from Meow Mix, wonderful group, right? Very institutional, like these guys. $60 million of revenue, $11 million of loss, $100 million of debt. So again, comp it out, guys. Put on your finance hats. $250 million in sales, 30 of EBITDA, own the channel, have a really nice long tail a la pharmaceuticals and being in 30,000 different pharmacies, along with the human pharmacies. Again, profitable. Did I mention that? No debt to speak of, only ABL. How would you comp that one out? Oh, by the way, Freshpet, went public about 3 weeks ago. $500 million market cap, day one. Day two, $700 million market cap on those kinds of losses. 66 to 70% market penetration already. So you look at that and you see the growth that they could take. They could only take another 30+% or create more market, maybe 50%. Still not projecting profitability. So what does this one comp out at, guys?
Over $1 billion.
What's the math on it? I hope it's over $1 billion. It's 4 times larger.
Exactly. And you're profitable, right?
And you're profitable.
You're $30 million profitable.
Yeah. So,
$30 loss, so you're probably close
so let's just do the math on revenues. You're 4 times their size on revenues, because that was a revenue IPO, right? Early stage, 4-year-old, 4.5-year-old business, 12-year-old business. Which one's got more opportunity to grow? This isn't about tooting a horn for a business, but I'm telling you, when we look at billion-dollar opportunities, this is where we look, where that puck is going, right? Where this is an opportunity. So you guys can draw your own conclusions. We don't know. The public markets will create those conclusions. You can do the math on what that looks like, but this is where we look at billion-dollar and multi-billion-dollar opportunities, and we're really excited about what this one is. Our goal, as I mentioned to you, is to focus in on the Mountain West, and if we can, bring them here to our backyard. And that's why the manufacturing primarily is taken care of here in Utah. Let's click. This clicker might. Okay, Curza. Definitely not heard of Curza. So Curza only has a handful of full-time employees. But this is where our business gets really involved in what we do on a day-to-day basis. In fact, today's kind of an exciting day because the comp that's probably 5 years ahead of this one was just acquired. Cubist Pharma, if you've got your laptops, look at it, was acquired for $9.5 billion, net of $1.1 billion of debt. It's an $8.4 billion market cap or transaction, right? That's almost twice what they were trading at when the day before the offer came through and as they worked on this. This is an antimicrobial. But this is a good example of what we do and how we try to add some asymmetry. It is not, let me write a check, close my eyes, bring my money back to me, plus a return later. It is where we can involve our C-level suite becomes their C-level suite. Our CFO then becomes an interim CFO for an earlier stage business. We will, instead of, for example, many of you have looked at technologies that come out of the TCO, the Technology Commercialization Office here at Brigham Young. Well, you come to my office and you say, hey, I've got the greatest idea of all time, and I'm going to show it to you, and here's what it is. I'm going to ask you, well, are you willing to leave school? And you're going to say, no way. I'm a sophomore, and I've got X number of years left, and I'm not going to leave school. It was hard enough to get into this. I'm not going to try to leave. You're also not likely to have had experience as a CEO. Now, some of the best CEOs I've ever seen are without experience. But if I'm betting on somebody, I like somebody with a track record. I like to increase our odds. So what we did is we found a CEO for this one. Instead of saying, hey, you've got this great idea, bring it to us, we search out our own ideas. We look for these technologies. This one happened to come out of the TVC, the University of Utah's version of the TCO. We brought in a CEO who had run a KKR, Excel, Bain portfolio company, sold it for a nice 9-figure number at the height of the dot-com bubble, after it had burst, actually. So we still got a great valuation on it. And then we bring in a little bit of seed capital. We add our C levels, secure the talent, make sure that this is a great working model. We'll build a world-class board. This board, former Bush Secretary of Health and Human Services, former head of the EPA, former director of Eli Lilly and founder of Eli Lilly's drug discovery department. One of the founders of Bain Capital on this board. Does that sound like a world-class board to you? It does to me. That's a great business in the make. All the right pieces of the recipe. Now, is that a guarantee for success? Absolutely not. But we like to increase our odds by bringing in the right kind of talent and a world-class board. Then we'll go out and look for institutional capital. And today, as we speak, Curza is about a 1 year, 3 months, so 15-month-ish old company. It's got 300 compounds versus the dozen compounds when we founded it from the scientific team. It's got a first-of-a-kind patent in antimicrobials. Doesn't sound very exciting until you think about a cargo ship full of oil coming from the Saudi Gulf that's got 100 million barrels of oil. Do the math on that. It's easy at $100 a barrel. It's no longer that, more 60, high 60s now, right? But do the math on it. 5% of the cargo is either tainted by biofilms or it's gone. Bacteria has consumed it. It actually eats it and leaves behind. When you see the guck in oil, that's bacteria. That's not what oil looks like coming out of the ground. And so that's what something like this does. And that's not to say that that can't be done by other groups. But guess what? When you're doing that with a hazmat suit on versus a group that'll allow you to drink it like a glass of water, that's a nice value proposition. No one in the world can both kill bacteria as well as disperse these biofilms. So what does that mean to you? If 5% is tainted, even after administering an antimicrobial, that's a pretty powerful idea if it's $500 million of cargo every time that's being lost. So those are powerful ideas. Then you take it into something like HAIs, hospital-acquired infections. You know how many people in America die from hospital-acquired infections? You know, you go in to get your knee scoped, you come home and you've got any number of diseases, MRSA, staph infection, things that people die from. You know how many people in America, best hospital system in the world still, believe it or not, how many people? Any guesses? Six-figure number. It's 100,000 people die every year from these hospital-acquired infections that they got after they went to the hospital. This can prevent that. Powerful idea, powerful concept. What's that worth to save 100,000 lives? Or take it to the third world. What is it worth to eradicate tuberculosis? Because that's what the Gates Foundation believes that this company will do. That's why they're putting their money where their mouth is. And that's an exciting thing to think about. Those are the things that keep you up at night, thinking about how you can do better and be that steward that we were talking about. Just a couple of the portfolio companies that we've been involved in and founded from their very inception. You guys probably know HireView. That's a Sequoia deal now. Great entrepreneur. Helped put together the technology for them, and we're the founding investors. Some of these others that I've talked about. This is one of my professors that talks about knowing what you do well and then doing it. And that you can have the best strategy in the world, but it's really about execution. And I think if we do one thing well, I've already talked to you a little bit about aligning ourselves, but the other is execution. We align ourselves with our partners, our employees, our vendors, our partners in every way, but we execute, we do it. And that's the asymmetry that we create. You guys know this guy. You know this guy? I hope, right? So Steve Young, Hall of Famer, an alumnus here of BYU and the law school as well. When I was interviewing for my dissertation, I interviewed 17 individuals that had either started what became billion-dollar businesses or had helped from a C-level suite build and grow these businesses. So 17 individuals. And you know how much they had created in terms of aggregate enterprise value? Or managed in terms of aggregate enterprise value? Steve's on that list, by the way, because he's one of the managing partners and founders of Huntsman Gay, HGGC. It was just slightly less, $473 billion, just slightly less than $500 billion of enterprise value amongst these 17 people. Powerful sample? Yeah, powerful sample. Important questions that I had to ask? I thought so. But the one question that was the most telling for me was what I wrote up here. Do you love to win or do you hate to lose? What do you think? It's magnanimous. Look at him. He's hugging that Super Bowl trophy up there, right? What do you think Steve said? Love to win, right? That's the magnanimous, sort of generous comment that you would think that you would make. You love to win. So that's exactly what he answered. I was at Pebble Beach. We were in a car. I was interviewing him as we drove from the airport together and recorded this. About 20 minutes later, he said, James, I got to stop you. I got to tell you that, that question about loving to win and hating to lose? I actually just hate to lose. What does that mean? What does that mean that a guy like that hates to lose? And that's the real driver in an athletic career, in his business career, perhaps in his family, additional relationships. What does that mean? Well, I had an opportunity to study that a little bit more. In fact, I asked this partner of his, they have a foundation together, and Jerry Rice was there at Pebble Beach with us. And I asked Jerry the same question. Jerry's is easy. Yeah, I hate to lose. So think about that as you're thinking about your career, because I've found it that you think you set up the rules in an organization, that you've got this great big carrot out there for people to grab. And sometimes a carrot is not enough for excellence. Sometimes that little stick, or sometimes fear, and this is a tough one to get past and think, but I've got the data to show you that sometimes that fear of loss is more powerful than actually a love. And we could spend the next several hours on that one, but think about that as you're setting up your businesses. Think about that in your career, that sometimes it's not the love is just not enough to drive you to excellence. It might get you here, but sometimes it's not there. And I know that I sound probably, that's not in the spirit of the loving education that we talk about sometimes here at BYU, but that's one of those that is worth exploring. And as you build your businesses, think about that one. 4 powerful principles. I'll end with this, okay? Beware of entitlement. Anybody sold pest control or alarms for the summer? Myself. I've never met a more entitled group, period, in all of my business. My first business, as I mentioned, was a summer sales organization selling satellite dishes door to door. I would say the same about folks coming out of any school where they take pride in it. Don't make where you went to school the best thing about you. That's a great education. It was hard to get in here at BYU. It's the same profile as going to a Stanford, but it can't be the best thing about you. What you're going to do down the road has got to be the best thing about you. Don't feel entitled. We talk about entitleitis in my organization. It's a disease. And I don't mean to pick on those, including myself, who have sold pest control or alarms during the summer and made $100,000 during the summer. You're just not as great as your paycheck says you are. It's that simple. It's a great way to make a living. But I don't know many guys, apart from those that are managing there, that make it a career. I love Vivint. I love Todd Peterson. We have a great relationship. But don't fall victim to entitleitis and believe that a paycheck defines you. Don't believe that your school of choice and where you went to university defines you. Doesn't matter. We find a lot of, I've hired the guys from the right schools, from the Harvards and the Yales and Northwestern, and I fired a lot of them too, guys. Don't make that the best thing about you. The best is yet to come for you, so don't be entitled. Second is cross the chasm. So you can see this. You got to bridge the gap. This is a sad story. It was one of my early investments, set up to be a drugstore.com, set up to win the race in selling pharma online. They would never launch the website. And today it's kind of a placeholder website if you went to their site. Just would not ever try, so they could never find out what didn't work. They had the capital, they had the products, just wouldn't try. Cross the chasm. And that's the scary part, but you've got to do that in starting your businesses. You guys know Nathan Furr from here at the university. Nail it and scale it. We talked about that a lot at Clearlink. And then the last here, fail fast. If you're going to fail, do it quickly so you can move on to the next thing. I talked to you about a failure with Contour. I think there's success on the horizon there. I really do. I want to come back and report on that one. But fail fast if you're going to fail. It's how you can correct your behavior and move on. That doesn't mean fail. I don't want you guys to set yourselves up for fail and say, oh yeah, it's okay. James Clarke said if I fail fast, and then sit back in your lounge chair. Fail fast so you can pivot to where success really is. That's where success is hiding for you. But it's after you pivot again. The last thing is, my experience growing up was, I worked for my dad. I grew up in Rexburg, Idaho. He wrote a check every week. I think I made $1.33, $1.50 an hour on average when I started working for him at about 10, 11 years of age. Then I went and worked on a farm. But every week, he would write me a check for the full week. And in the little memo section, the little memo section in the bottom left hand, he would write this, labore et honore. Anybody know what that means, Latin? Pretty simple, take off an E, right? Labor and honor. If I had done a good job, labor and honor. If I had done a not so good job, labor. Labor is not enough, guys, especially coming out of this university. labor with honor. Learn, earn, and return. It's a blessing that you're here. I'm grateful that I can be here in front of you. I wish you all the best success, and I thank you for being here today. Thank you.